Hey, thanks for watching. Coming to you from Fool Global headquarters in Alexandria, Virginia. I'm Chris Hill, joined by Motley Fool co-founder David Gardner. Thanks for being here.
I'm delighted to be here. Thank you, Chris.
We're going to be talking about how to pick great stocks. We're going to be taking your questions about stocks, so go ahead and get those ready. Let me start with this, and not that the people at MarketWatch need any additional promotion from the likes of us, but MarketWatch this week out with the 20 best performing stocks of the decade, and a quick check of this list finds a bunch of stocks that you have recommended over the years through the services that you run. Netflix, Amazon, etc. TakeTwo Interactive. I kind of want to say would you like to, start with, would you like to take a victory lap? But knowing you as I do, I know you don't want to do that. But I'm guessing that at least part of your mentality when you see an article like this is why we invest for the long term. This is why we're looking to hold great companies, because when you look to hold them a decade out, you're going to get those kind of returns.
You're right, Chris. A lot of it comes down to what is your mentality, your mind frame, time frame. And so those articles come out about once every 10 years. So we try to be stars once every 10 years when those articles come out. But we're maybe one of the few out there that are playing the 10-year game. I mean, there are some other great investors who play that. And I think all of us, whether we're brand new to the markets or grizzled veterans of multiple decades. But Chris, you and I are mom and pop investors. We're individual investors like everybody, or most people watching this. There are no specific gadgets we're using. We're not hedge fund managers. We're just playing the long game. And it's a tiny crowd that does that. But that's the only real game you want to win, right?
Well,
that's the big game.
It is one of the few advantages that we as individual investors have, is if we're able to take that time frame approach. You and I have talked before, a lot of times on Wall Street, if you're watching financial television, that sort of thing, when they use the phrase long term, they're literally referring to
next week.
Well, 6 months out, 6 to 12 months from now, thinking long term. Real quick, before we get into your process and the way you go about finding stocks, some of these stand out as obviously great companies and category leaders like Netflix and Amazon, but others are sort of, they're not necessarily household names. Like a company like TakeTwo Interactive, people who are familiar with video games may know some of the titles. What first attracts you to a company like TakeTwo Interactive?
Well, for me personally, it's a company that I know as a consumer, so that's the easy answer for me. I'm a big fan. Grand Theft Auto, Rockstar, which is part of that label. They also have the 2K games, and so they're video games that I recognize as a player. It's also a very long-term oriented company, and they're able to just kind of improve their products over time. One thing I love about video games versus movies, Chris, is the sequels in video games get better, and the sequels in movies usually don't. So I love the dynamic of a world. By the way, video games are a gigantic business today. When we first started investing, I mean, it may still sound pretty geeky to people today, video games, but back then it was like obscure. Like video games, that would be something. These days it's a massive business. And so TakeTwo Interactive is not even the biggest player in its field, but what a great stock it's been over the last decade for rule breakers, members. And yeah, so but for me, a lot of it is when I use the product or service myself and love it.
So when you're looking for stocks to recommend through your services, to buy in your own personal life, I know you tend more towards growth stocks, smaller companies. What are a couple of the things that you like to see? Because the stocks that you recommend go across a range of industries. So it's not like you're just focusing on retail or just focusing on entertainment. What are a couple of the things that you like to see, whether it's from growth metrics themselves or company management?
Yeah, I mean, the first thing that I don't even look at metrics. The first thing I want to see is what is the purpose of this company? What is the mission of the company? We've come up with our own mission at the Motley Fool. All of you probably work in organizations where they have their mission or purpose. That matters deeply to me. I want to have companies that are going to make our world better. And not every company does, Chris, and we're not going to call it any names, but I do listen to Market Foolery virtually every day, and sometimes we talk about companies that aren't so great for the world. And by the way, what each of us sees in the future and what we think is a better world is different. So, I mean, we're all motley here, but for me, I start with, is this something that is going to make our world better? And invariably, my best companies are the ones that really have made the world better. But then, of course, I love to see a product or service that I think is great, that is superior. I usually am looking for the top dog and first mover. And not just in any industry, but in important emerging industries. So Amazon, which you mentioned, which might sound like old hat, like, wow, well, anybody could have picked Amazon the last 10 years. Well, actually, 10 years ago, a lot of people were saying Amazon's toast. It was 2008 and 9. Where are the profits? Those sorts of things. So even the ones that sound like the obviously great picks today, Netflix went through an incredibly brutal 2011, right? So it's easy to see in retrospect how the world beaters became that, but we're finding the companies at much earlier stages buying and holding them, and in part because we're looking for important emerging industries, streaming entertainment, e-commerce, right? So it's the big, broad shoulders of new, important, emerging technologies that are usually going to yield the world beaters on the market. And as you said earlier, to close this answer, this long, shaggy dog answer, Chris, as you said earlier, we're holding them for 10 years. We've held Amazon for 25 years. We've held Netflix since 2002. The only way you're really going to make money on these companies is by being patient, being an owner. The purpose of our market's not to trade, to invest.
Well, and you mentioned something there that I think is worth keying on for a moment, and that is Amazon and all of the questions around its profitability. And part of what can work in our favor as investors is the combination of taking that long-term approach, but also being willing to be patient for companies that aren't profitable right now, and thinking, you know what, I think they're going to get there. I have faith in the company's management because, again, for businesses or investors or hedge fund managers, that sort of thing, that are taking a shorter term approach, they can't wait a couple of years for a company to get profitable. They need it to happen sooner. And if you're able to do that, then the payoff can be enormous.
It's true. Now, not every stock that we pick early stage is unprofitable. It's going to need to be a special company. To be unprofitable for a persistent amount of time, have the market willing to trust that, and have that be a great stock. Of course, we've had a lot of IPOs here in 2019 where they sounded like great companies, and yet they're not profitable and haven't been for a while, and there are questions about the profitability of some of the big IPOs of 2019. So I think that you have to be patient, but confident that that company is doing something that will be profitable. Not every big IPO is that way. We obviously try to stay out of those, although I make all kinds of mistakes. Uber has not been a great pick for me in 2019, for example. So in the end, I think it's important to spread your bets out and be invested for long, persistent periods of time. It's a lot easier, more fun, and a lot more profitable.
All right, we're going to get to your questions in just a moment. Plus, David's
Great.
got 5 stocks if you're looking to build out a watch list. But let me ask you more of a mindset type of question, because a couple of the companies that we've talked about, Netflix, and you mentioned the drop that it had, what I like to call the Quickster debacle.
Yeah, it was more than 2/3 of its value in just a few months.
So when you see a business like that go through something like that, or just more recently, TakeTwo Interactive, between late 2018 and early 2019, stock falls about 40%. What are the things that you're looking for that make you as an investor say, I'm sticking with this company? Because there are plenty of investors out there who, in the lead up to the Quickster debacle, or in the lead up to late 2018 with TakeTwo Interactive, they thought, you know what, I've made some money with this stock. It looks like they're hitting a rough patch. I'm out. What makes you stick?
Well, first of all, my mentality truly is that I'm just going to own this forever. Like when I buy a stock, I don't think I'm going to sell it. I think that's not true of most people's mentalities. They think they're going to sell it, and they wonder, when should I sell it? And they're thinking probably soon, or there are some triggers they're looking for. They might have a price target, up or down, or they just don't have the buy forever mentality. So, Chris, there's no brilliance to this. It's really, obviously, very lazy. But I have to have a strong reason to sell, and it's not going to be the performance of the stock. So I will also mention, and I want to make this really clear, that I have more losers than any stock picker in Motley Fool history. I have more bad stocks and more bad stocks. So that's really important too. If you want to take the rule breaker mentality, you have to be willing to lose, to look silly, sometimes 10 times in a row or 3 years in a row. You have to be willing to let Netflix go from 100 down to 25. Or I bought Amazon at 3, it went to 95. That felt amazing the first few years in the 1990s. And then in 2 years, it went from 95 down to 7, which felt horrible. And I just kept holding, and I've held all the way through, right? So you have to be willing to allow companies to fail badly for persistent periods, knowing in the end that they're world beaters, world shapers. And by the way, maybe you'll be wrong. And if we lose, that's just another loss. But as stocks decline in value, they start to decline in meaning for your portfolio, right? The really consequential stocks are the winners that roll up to bigger influences over your portfolio. So I really don't worry too much about losers, which is odd in a world where most people are obsessed with not losing.
All right, let's get to some of the stocks for folks who are looking to build out a watch list. First up, you've got Datadog.
Sure. I mean, Datadog is a recent IPO and it is an outstanding company. It's a company that allows people in a cloud computing world. If you're a business overseeing, you want to know how all your cloud assets are doing, how your system's doing, and Datadog enables you to monitor that. It also gives you insights that you wouldn't have gotten otherwise into what's happening within your cloud assets. So it happens to be a company with a dollar-based net retention rate, just about as high as we've ever seen, 146%. So that means that $1 of a customer's business last year became $1.46 this year. So that's not only 100% retention of all customers, that's all customers net paying well more into the company this year than last year. So that's a remarkable statistic. DDOG is the ticker symbol. I mean, I like the brand. Why don't you like dogs, Chris Hill? What do you have against dogs?
I love dogs.
So you love dogs?
Who doesn't love dogs?
Yeah, I don't know why I said that. Everyone loves dogs, and I love Datadog. I hope it'll be a good
It's
performer.
cats that I'm allergic to. Datadog, maybe not a household name. This next company, absolutely a household name, Walt Disney.
What do you know about Walt Disney?
The business or the man? I know more about the business.
Let's talk about the business.
They delayed the launch of Disney Plus by roughly a year and a half. There were a lot of questions going into the launch, and they appear to have nailed it. For anyone who's a shareholder like me who is thinking, okay, we've been waiting for this, let's make sure you get this right. Right now, they appear to be off to a great start.
Yeah, and so that you can speak so ably, and I listen again every day to Market Foolery, our wonderful podcast, which you and Matt Greer host, Chris. So, I mean, Disney's just one of those companies you're going to constantly come back into contact with, starting from a very early age, all the way through to one day when we have grandchildren, Chris, we'll be taking them to Toy Story 9, right? And so don't you love a company like that? And ironically, the way that we found Disney for Stock Advisor at very low cost bases is not through Disney itself. We consistently were recommending Marvel, which then got bought out, and Pixar, which then got bought out. So these are all incredible brand assets. Obviously, they're not just comic books like Marvel or movies. They're these days, they're in the theme parks, Star Wars. You've heard of Star Wars?
A little something, a couple of things.
What do you know about Walt Disney the Man, by the way?
Hell of a mustache.
Did you know that he was cryogenically frozen at death?
I was unaware of that.
That is actually a urban myth. It's
Okay.
an urban myth, but a lot of people walk around thinking, hey, yeah, he was cryogenically frozen. That's not true. Walt was just buried normally. So check Wikipedia.
Are we going to have little stats like that coming up for these last three companies?
Probably not, because they're not as well known. I haven't checked the Wikipedia page.
Up next, Etsy. For an online retailer, Etsy has done, I think to this point, a great job of staying as Amazon-proof as an online retailer can get.
Yeah, and that's because in a world in which Amazon does an amazing job getting us all of the mass market goods, in my case from board games right through to books, right through to 10-foot ladders, Etsy has the space where you find unique gifts. It's for craftsmen and fans of crafts. And right around holiday time, it's a great place to find something unique. You wouldn't find it on Amazon. It's on Etsy, especially in a world where millennials, the largest generation ever born, are intentionally asking, with intention, if I spend money on that product, will the world be better off than if I spend it on that? Etsy's beautifully positioned, supporters of crafts worldwide. This is a stock, by the way, that has dropped from 72 to 42 since late July. So right now, 4 months or so, it has lost about 40% of its value, and yet it's still up a couple times in value just over the last 3 years. So I really like Etsy right here going forward. Of course, we're not talking about the next month, this holiday season, or next year. We're looking 5+ years forward. Etsy has been a great winner over the last 5 years. I predict it will be over the next 5.
All right, last two, Intuitive Surgical and PayPal, two very different businesses. Let's talk about surgical robots for a second.
Yeah, I mean, I'm glad that we are talking about surgical robots because they're so different from Pixar movies and from cloud monitoring systems and as we just talked about our friend Etsy, right? So I love the diversity of companies we have here. And, you know, Intuitive Surgical is a company that has dominated the space of robotic surgery. For those who are trying to picture this or aren't familiar, this is not robots coming in like Lost in Space, that robot, and doing surgery on you. It's really surgeons, highly skilled, like video game generation, coming in, putting their hands into mitts that then drive on table over a body, having your prostate gland out, let's say if you're an older man, and it's done with incredible machine vision, incredible precision the human hand could never matter, minimally invasive. And this is a company that has grown up with Motley Fool Rule Breakers. We picked it 15 years ago, and back then it looked like this kind of earlier stage, will this work out? And today, Intuitive Surgical has an R&D budget larger than the revenue lines of most companies in its industry. So this is a spectacular, one of those businesses, Chris, razor and blades. Are you familiar with this model?
Absolutely.
There's the razor, but where's the money made?
The blades.
That's it. And Intuitive Surgical, every single one of these surgeries that's done, there are parts you have to replace. So it's a great, I mean, they're being paid back every day for getting these world-beating, worldwide, it's a global phenomenon, leadership in a really important area of surgery that's just going to keep growing.
Last, PayPal, as much as any business that's disrupting cash, PayPal is front and center on that.
Yeah, and I like that we have a mix here of smaller companies like Datadog and Etsy, big dogs like Disney, Intuitive Surgical, and PayPal. And so it's a reminder, you don't have to be looking for dodgy early stage companies that your Uncle Hal told you about that aren't even listed, you know, on the NASDAQ, they're over the counter. That's not the way to great riches on the stock market. That list of 20 best performers in the last 10 years, I think we had about 10 of them under recommendation here at the Motley Fool, 10 of the 20 over the past 10 years. Those are the companies, Amazon, Netflix, right? PayPal, which we're talking about right now. It's these very substantial businesses that have long ramps of growth with worldwide relevance. These are the stocks to buy and hold. And, you know, a lot of people own PayPal for like a year, or they, you know, it was a good trade for them in 2016 and then they didn't get back in or whatever. We are literally just buying and adding to positions that grow over time. We're not paying commissions to exit. We're not paying capital gains taxes at the end of every year where we're trading. Nope, we're just efficiently holding great companies. PayPal and Obvious. Great. I think most people are familiar with the business. We don't have to remind them. Venmo, etc.
All right. If you want access to even more of David Gardner's stock recommendations, just go to fool.com/RB. And if you're enjoying the video, please give us a thumbs up. Give us a little like there.
At least Chris's part. If you can target your thumb, definitely give Chris a thumb.
Or at least if you're looking for more, you know, data like David was sharing about Walt Disney. Anything, really anything, just to give it helps other people find the video is my point.
He was not cryogenically frozen, and people are walking around this earth thinking that he's waiting to come back at some point. It's not true.
Let's get to some of the questions that are coming in. A lot of great ones. Mark asks, I feel as though I missed the boat on Shopify. Is it too late to buy shares?
I mean, no, it's not too late. Shopify is in the golden age of growth for an e-commerce enabling company, right? Amazon is the company that basically top down, working with partners, sends stuff to all of us. Shopify enables all of those marketplaces. Shopify is connected into Etsy. If you want to be a craftsman anywhere around the world, you want to open up your own website, start a business, maybe sell through Etsy, you're using Shopify for a lot of that potentially. You can have Shopify run your own e-commerce business at chrishill.com. Are you using Shopify?
Not yet, still in the prototype, but yeah, once we get chrishill.com up and running.
So yes, so that may or may not have been serious, but more seriously, Shopify today is a company with you know, a market cap of about 43 billion. That's about, you know, 1/25th of Amazon. Amazon tried to compete with Shopify and then ended up saying, we're not going to enable other marketplaces. They're doing it too well. We're actually going to sign on board with them. So Shopify is a brilliant company. It is one of our fastest 10 baggers that we've ever had at the Motley Fool. It's been a tremendous rule breaker. Please don't look backward and think you missed it. How many people thought that about Netflix 10 years ago or Amazon 10 years ago? They didn't miss it. They had some of the best performing stocks of the following 10 years. So I think that Shopify could well do that again.
Pauline asks, if you had $100,000, would you divide it equally among these 5 stocks, and would you invest that amount a bit at a time or all at once? Great question, particularly as people are in the 10-year bull market that we're in.
Yep.
Maybe they've got some cash looking to deploy it. Great question from Pauline.
Yeah, so Pauline, there's a lot of context there that I can't speak to because I don't know you. And so each of us needs to figure out what makes sense for our situation. If you're saying you had $500,000 and that's all you're putting in the stock market, I would say don't put 100,000 in each of the 5. Put about maybe 25 to 50,000 in each of these and add in 5, 10, 15 more stocks. Build out a 20 stock portfolio. So if you already have 15 stocks and you have an extra 500K sitting on the side, then sure, you could put 100,000 in each of these. I do like to spread evenly. I don't load up on one, let's say Etsy, and not put in as much in Disney. I like to spread it evenly and then let them perform and show you the allocations they deserve, and don't touch it or monkey around with it. So, but there's a lot of context missing in a question like that, Chris. So I hope it's clear, though. The general advice is, yes, spread your bets evenly among these companies. I hope you have at least 15 more besides, and then let them live and breathe and become the successful businesses that they will over the next, not last, over the next 10 years.
Dale asks, I have more than 90 stocks in my account. Is that too many?
So there's no right number. So Dale, I would say if it feels like too many to you, maybe it is. We have members who have bought virtually every stock we've recommended in Stock Advisor, which is a couple hundred now over the years. So I would say this, it's not so much about the number of stocks you have, it's about how much time you want to spend tracking your stocks. So in the family portfolios that I manage, I'm going to say we have about 55 stocks. So that means we have a few stocks that represent bigger allocations. I spend a lot of time looking at those companies. Among those 55, for me, we have some that are worth less than 1% of the overall account. I spend very little time. So I think you should be asking, A, how much time do I have and want to dedicate to this? And then B, let me make sure I'm spending my time on the positions that matter, and don't freak out and feel like you have to follow earnings reports. I don't for all 55 of my companies. I'm going to stay focused on the middle and bigger positions.
Lisa asks, your service recommended Peloton. Can you talk a little bit about why you like the stock?
Sure. Now, am I talking too fast, Chris? I feel like I'm just going crazy trying to fit in all the questions.
I'm keeping up with you.
Okay, if at any point you feel like I'm going too fast, just go like that.
Okay.
I learned that in The Sting.
We all learned that in
Okay,
The
good.
Sting, yeah.
So let me know. I'm just going to keep powering through. Okay, so what was the question again?
Peloton. Why do you like that stock?
Peloton, yeah. So I like Peloton a lot because it has a brand name, it's carved out of space, and it's tech-enabled, and it creates community, and people get healthier, and it gets a lot of people dinging it, saying it's overexpensive, it's always gonna be too high-end a brand, and people buy the machines and then they stop using them, a lot of times other machines anyway, or they get their gym membership and they've canceled by February, these kinds of things. So I feel like that's a dark cloud that I can see through. This company came to me through our Rule Breakers team and Tim Byers, whom I'm sure a lot of you know, but Tim was the one who advocated most for it, and I said no, like the first 4, 5, 6 months, and then finally I said, yes, I actually believe in Peloton. So we'll see. I also said earlier that I pick more bad stocks. I'm wrong all the time. So I certainly could be wrong about any of the companies that we highlighted earlier or Peloton, but it has a lot of the marks of the things that I look for success for you and me as stock market investors. So go PTON. We'll see. Chris, have you been on a Peloton?
I have not been
Why
on
not?
a Peloton. Exercise doesn't agree with me. So
Me neither. I haven't been either.
A couple more questions, but first, one programming note. I've been told that ChrisHill.com redirects to a lifestyle real estate branding and marketing solutions company. So
Right, and when did you start that company?
I provided a little seed money, and that's all I'm going to say about that. Austin asked, David, what are a few of your research steps that you take to identify a stock advisor pick? Do you use screeners?
Right, I don't use screeners. I've never screened stocks. I love to find companies by flipping stones, bottoms-up investing, organically finding products or services that I admire, technologies that sound amazing. I learned so much from our Motley Fool community over the years, our discussion boards, Motley Fool Caps. And then also we operate as entrepreneurs. Chris, we're all entrepreneurs here at the Motley Fool. So we probably have a pretty good read on digital businesses. Some of our best stock picks have been companies that I can see pretty well because that's what we do here at the Fool. So each of us is professionals in our respective fields. That gives us an extra angle into those kinds of companies. So the way that I find these companies is I basically live. And one thing I try to do is lead an interesting life. Get out there, meet lots of interesting people, go to conferences, try new technologies. I'm the person with too many old dead gadgets in a closet of my house, but at least I bought them in the first place, right? I tried and I kind of believed, and they may or may not have worked. But I'll say this. I think each of us should be suiting our time and energy to the things that we love. And again, make your portfolio reflect your best vision for our future. So the stocks that I would encourage you to research and own should be the companies that you get to know. You might love them as a consumer, and you think, hey, I think that's a better world. Look at those companies.
Nate asks, should I use margin to buy stocks?
I mean, generally we say no. I don't use margin. Now, I mean, one level up, investment 101 as opposed to investment 1. Investment 101, sure, some people can use margin effectively. I mean, if you keep it at a low percentage, even if you just bought index funds and just over the course of your whole life did, but margined 10%. In other words, you borrowed 10% more than you had and put it in index funds, you would make more money over the course of your lifetime, even though you're paying some margin interest rate, because you had more money at play for a stock market that tends to go up 9 or 10% a year, right? So mathematically, and for those who do it responsibly, I think margin can be an effective way to grow your nest egg more. The problem is many people borrow too much on margin, and then when the market drops, all of a sudden, tide goes out, Chris. We find out who's not wearing Chris Hill pants.
Exactly. ChrisHill.com branded pants, please.
You didn't say earlier that was not part of the business. I didn't hear that.
It's part of it's a lifestyle company.
Is that an announcement we have today?
Mako asks, do you see a recession in the near term, and does that affect the stocks that you pick?
I never know when the next recession is coming. I haven't known the past ones. I was still buying in 2001 as the market got trashed. I continue to recommend stocks every single month in Stock Advisor and Rule Breakers right through 2008, 2009. Brutal times. It wasn't fun watching the market go down, but guess what? I've done something that I hope you've done. I've made a lifetime commitment to being an investor in the stock market. It doesn't matter to me. I mean, I hate it when the market drops, and I don't like recessions, but I know it's going to happen multiple times through my whole life. I'm 53. It's going to happen a lot more in the next 50 years for you and me as well. So the trick is not to care that much, not to overborrow on margin, do silly stuff. Really, let's just be foolish, capital F. Let's spread out, have diversification. Let's just keep adding with our salary every 2 weeks. Let's buy great companies, ones that you and I respect, that we admire, that we would love to work for ourselves. And let's ride out the recessions. Some people are brilliant. Probably they get out just before the recession. I don't know if they get back in right after the recession, though. But I mean, I guess somebody's good at that. But that's not the approach you and I need to take. I wouldn't be good at it if I had to do that.
Charles asks, when you provide new stock picks, are you suggesting that these are now better than your older recommendations?
Not at all. I think that's a great question, Charles. I mean, what we do in Motley Fool Rule Breakers, we make 2 new selections every month, new recommendations, and then in Stock Advisor I make 1. Some months I will re-recommend a stock instead of putting a new one in there, but in general I love having new companies because they're always coming along. But sometimes your favorite new stock should just be an addition to an existing position and old stock that you have. I would say there's no one-size-fits-all answer here. If you feel like you have not enough of a certain position, maybe add to that. On the other hand, I own a lot of Netflix today. It's an overbalanced stock in my portfolio. I'm not going to add to that one. So I think you have to look at the context of your portfolio, but it doesn't mean that the new pick we're going to make next week in Rule Breakers is the best one ever. It's just another, I hope, great new idea, a recommendation. We're accountable for everything, and maybe you want to buy it, maybe you don't need to.
All right, our last question, perfectly
one?
appropriate for the holiday season. A couple of people asking, David Gardner is a big fan of games. What are his favorite games right now? Maybe for people looking to do a little shopping.
Absolutely. Actually, I did my podcast, which is Rule Breaker Investing, on this topic this week. It's entitled Games, Games, Games. Clearly, Chris, you haven't heard my podcast because I already answered this.
It's in my queue.
Are we not listening to Rule Breaker Investing? So it's called Games, Games, Games this week. I actually give 4 family-friendly, fun, quick, casual games, and then 4 harder core strategy games. I'll give 2 real quick. One is a game called Just One. It's a wonderful, simple family word game. You can play with 7 or 8 people, so it's great for the holidays. And it's kind of one where basically one person holds a word over their head. They're not sure what it is because it faces out to other people, but everybody else knows the word, and they try to give you a synonym that helps you know the word that you're showing to them. But the trick is, if they duplicate each other, then they cross out and you never get to hear that. So the only synonyms you get were unique ones that people thought of, and so it's a great, infinitely replayable game. And then finally, one of the games of the year, Wingspan, which is a excellent strategy game. It's a beautiful bird-themed kind of Audubon cards, but all the birds have victory points on them, and you're trying to attract them to your aviary, and all the birds have special abilities. It's a little geeky in the best way. It's a beautifully produced game. So Just One, the word game, and Wingspan for people who like strategy games. There you go.
All right, you want more games? Check out David's podcast,
Games,
Rule Breaker
games,
Investing.
games.
If you're looking for more stocks, go to fool.com/RB.
And also chrishill.com.
chrishill.com for the pants and more lifestyle information.
And Walt Disney.
But really, fool.com/RB. David Gardner, we're out of time. Thanks for being here.
This was fun.
Thanks, everyone, for watching. We'll see you next time.